Silver, $100 shattered. Banksters panic as Shanghai hits triple digits. January 24th, 2026. A date that will be remembered, not for what was said, but for what finally broke. While most people slept, the barrier fell, $99.16. The number that was never supposed to appear just appeared. But that's not the real story. The real story is happening 7,000 miles away. In Shanghai, where the price isn't $99, it's $111, $12 higher, for the exact same metal, the same day, the same hour, two prices, one metal. Something just broke in the global financial system. And what comes next will change everything. Welcome, friends, to Economy Revelations. If you've been watching the financial markets long enough to remember when a handshake meant something, when a dollar actually held its value from one year to the next, when the news told you what happened instead of what to think, then you're in the right place. This channel exists for those who have seen enough economic cycles to know that what's happening right now is not normal. You don't need us to entertain you. You need us to show you what the numbers actually mean. So here's a simple request, the kind neighbors used to make before the world got complicated. If you find value in what we're about to share, click that subscribe button. Not for us, for yourself. Because what's unfolding in the silver market is just the beginning, and you'll want to know what happens next before your neighbor does. And one more thing, we're curious. Where are you watching this from? Drop your city or country in the comments below. Let's see how far this information is traveling, because what happens in Shanghai today shows up in your pension fund tomorrow. Now, let's talk about what just broke. There are moments in financial history that arrive quietly. No sirens, no warnings, no emergency broadcasts, just a number on a screen that wasn't there yesterday and changes everything today. January 24th, 2026 delivered one of those moments. The silver market, which had been contained, controlled, and carefully managed for decades, finally did what contained things eventually do. It broke. Not with a whisper, not with a gradual drift, but with the kind of violent momentum that tells experienced market observers that something fundamental just changed. At 8:47 a.m. Eastern Time, the Globex electronic trading platform, the digital heart of Western precious metals trading, registered a price that had not been seen in the modern era. Silver touched $99.16 per ounce. For anyone watching precious metals markets over the past 50 years, this number represented more than just a high price. It represented the collapse of a psychological barrier that had been defended with extraordinary effort. The $100 threshold in silver wasn't just a round number, it was a line in the sand, a declaration that paper currency still had meaning, that central banks still had control, that the monetary system created in 1971, when President Nixon severed the dollar's last connection to gold, could continue indefinitely. That line just got erased. But here's what most analysts missed while celebrating, or panicking, over the Western price breach. The real story wasn't happening in New York or London, it was happening in Shanghai. The Shanghai Gold Exchange, China's official platform for precious metals trading, closed its Friday session with silver priced at $111.66 per ounce. Not 99, not 100, 111. In local currency terms, this translated to 24,997 yuan per kilogram. The number itself was staggering, but the implication was far more significant. The same metal, the same day, the same hour, two completely different prices. This wasn't a minor discrepancy. This wasn't a temporary glitch in global markets. This was a $12 to $13 premium, meaning buyers in Shanghai were paying $12 to $13 more per ounce than buyers in New York for identical silver. In percentage terms, this represented an 11 to 12% price differential between East and West. In normal, functioning global markets, this situation cannot exist for long. And when the same asset trades at different prices in different locations, arbitrage traders immediately exploit the gap. They buy where it's cheap, sell where it's expensive, and pocket the difference. This process, repeated thousands of times by automated trading algorithms, should equalize prices within minutes, but it didn't happen. The gap remained. And in some trading hours, it widened. This told sophisticated observers everything they needed to know. The arbitrage mechanism, the fundamental force that keeps global markets aligned, was breaking down, not because traders didn't want to execute the trade, not because the profit wasn't there, but because something in the physical supply chain had seized up. Arbitrage in precious metals isn't like arbitrage in stocks or bonds. It requires physical movement. An arbitrage trader who buys silver in New York at $99 and sells it in Shanghai at $111 must actually ship the metal. They must move bars from vaults in London or New York, load them onto insured transport, clear customs, and deliver them to approved vaults in China. This process takes time, it takes logistics, and most importantly, it requires available physical metal. The persistence of the Shanghai premium suggested that one of these elements, most likely the physical metal itself, was no longer available in sufficient quantity to close the gap. For weeks leading up to this moment, there had been signs. Large institutional traders with short positions, bets that silver prices would fall, had defended specific price levels with unusual aggression. At $95, waves of sell orders appeared, pushing prices back down. At $98, the same thing happened. These weren't natural market movements. These were deliberate interventions. Every experienced trader recognized the pattern. Someone with enormous capital and enormous motivation was trying to prevent silver from reaching triple digits. They threw paper contracts into the market. They triggered margin calls on smaller traders who had bought silver with borrowed money. They coordinated selling during Asian trading hours when liquidity was thinner. But on January 24th, none of it worked. The market simply walked through every barrier as if it wasn't there. The selling pressure that had worked at $95 failed at $98. The tactics that had worked at $98 failed at $99. And when the price finally pierced the $100 level, even briefly, it confirmed what many had suspected, but few had said aloud. The managers had lost control. The institutions that had kept silver prices contained for decades no longer had the firepower or the physical metal to maintain the ceiling. And once that ceiling broke, the mathematical realities of their positions came into sharp, dangerous focus, because somewhere in the world there were traders holding massive short positions in silver. They had borrowed metal they didn't own and sold it, betting they could buy it back cheaper later. At $50 per ounce, this was profitable. At $70, it was manageable. At $90, it was uncomfortable. At $111, it became something else entirely. It became insolvency. Every controlled system has a blueprint, not the official one shown to regulators and the public, but the real one, the one that shows how pressure points are managed, how perception is shaped, and how markets that should be free are quietly guided. The silver market's control architecture didn't begin with a conspiracy. It began with a problem. August 15th, 1971. President Richard Nixon appeared on television sets across America and announced that the United States would no longer convert dollars into gold. The decision was presented as temporary. 55 years later, it remains in effect. That single decision transformed every currency on earth into what economists call fiat money, money backed by nothing except trust in the government that issues it. But trust is fragile, and governments knew it. If citizens lost faith in paper money, they would flee to what they had trusted for thousands of years, gold and silver. Not as investments, as alternatives, as escape routes from a monetary system built entirely on confidence. So a quiet understanding emerged among central banks and their allied financial institutions. The price of monetary metals, especially silver, the poor man's gold, could not be allowed to rise too fast or too far. Not through official price controls. That would be too obvious, too Soviet, too honest. Instead, the control would be embedded in market structure itself. The mechanism was elegant. In the 1970s and 1980s, futures exchanges like the COMEX in New York became the dominant venues for price discovery in precious metals. Unlike physical markets, where actual metal changes hands, futures markets trade contracts, promises to deliver metal at a future date. The beauty of the system, from a control perspective, was that it required almost no metal at all. A bank could sell 100 contracts representing 500,000 ounces of silver without owning a single ounce. As long as most contracts were settled in cash rather than physical delivery, the system functioned. And as long as the banks could collectively sell enough paper contracts during price rallies, they could create the illusion of abundant supply, even when physical supply was tightening. The London Bullion Market Association refined this approach further. Through their unallocated account system, investors could buy silver without anyone actually setting aside specific bars with their name on them. The silver existed somewhere in the vault system, theoretically, but multiple claims could rest on the same physical bars. It was banking applied to metal, fractional reserve precious metals. For decades, this architecture worked flawlessly. When silver prices began rising in 2008 during the financial crisis, concentrated short selling appeared at key levels. When prices approached $50 in 2011, the CME Group, which operates COMEX, raised margin requirements 5 times in 8 days. Suddenly, traders needed to post far more cash to hold their positions. Forced selling followed. Prices collapsed. The pattern repeated in 2020 when COVID-era money printing sparked another rally. Heavy selling during Asian hours, when fewer market participants were active, pushed prices back down before Western markets opened. By the time American traders arrived at their desks, the rally had already been killed. But the most revealing evidence came from regulatory data that few people ever examined. The Commodity Futures Trading Commission publishes a weekly report called the Commitments of Traders. It shows how different categories of market participants are positioned: commercial traders, large speculators, small traders. For years, a peculiar pattern persisted in silver. A small number of commercial traders, primarily large banks, held enormous short positions. not hedging positions from mining companies protecting their production, just naked shorts, bets that prices would fall. At times, just 4 banks held short positions exceeding the entire annual global silver mine production. 8 banks controlled positions representing more than a year of world industrial demand. The concentration was extraordinary, and it was persistent. Every time silver prices rose, these short positions grew larger, capping the rally. Independent analysts documented this for years. They published the data, they filed complaints with regulators, they gave testimony before Congress. Nothing changed, because officially, nothing illegal was happening. The banks were providing liquidity to the market. They were market makers, facilitating trade. But there's a difference between making markets and making prices, and by 2025, the architecture was showing cracks. China's Shanghai Gold Exchange had introduced yuan-denominated silver contracts, creating an alternative price discovery mechanism outside Western control. Physical demand from solar panel manufacturing, electronics production, and 5G infrastructure deployment was consuming silver faster than mines could produce it. ETF investors, burned by repeated price manipulations, were increasingly demanding physical delivery rather than trusting paper proxies. Most significantly, the paper-to-physical ratio, the amount of paper claims versus actual metal available for delivery, had grown to levels that defied mathematical sustainability. Some analysts estimated that for every ounce of physical silver available in COMEX warehouses, there were 200 ounces worth of paper contracts outstanding. This worked fine when only 1 or 2% of contract holders demanded delivery. But what happens when 5% demand delivery? 10%? 20%? The architecture doesn't bend, it doesn't adjust, it shatters. And the institutions that built it, the ones holding those massive short positions, face a problem that no amount of paper selling can solve. Because when prices break through psychological barriers like $100 per ounce, the traders on the other side of their bets start demanding something the banks cannot print. They demand delivery, physical metal, real silver, bars in hand. And somewhere in the vault systems of London and New York, someone is running calculations on a spreadsheet, looking at available inventory, looking at outstanding delivery obligations, and realizing that the numbers don't add up. They never did. The system was designed to function as long as no one looked too closely, as long as trust remained intact, as long as paper was accepted as equivalent to metal. January 24th, 2026 was the day that equivalence broke. The Shanghai Premium wasn't just a price signal, it was a vote of no confidence. And votes of no confidence, once they begin, rarely stop at borders. There's a moment in every empire's decline when the rest of the world stops pretending. They stop nodding politely at economic statistics that don't match reality. They stop accepting prices set in distant trading rooms by institutions they don't trust. They stop waiting for permission to build their own systems. For the Western financial establishment, that moment arrived quietly. In a city 7,000 miles from Wall Street, Shanghai didn't announce it was taking over global silver price discovery. It simply started doing it. The Shanghai Gold Exchange, officially launched in 2002 but largely dismissed by Western analysts for 2 decades, had been steadily building something that traditional financial centers failed to recognize until it was too late. Not just another commodity exchange, not just another trading platform, but an entirely parallel ecosystem where physical metal, not paper promises, determined price. The difference was foundational. When a trader bought silver on COMEX in New York, they received a contract, a legal promise of future delivery. Most never intended to take delivery. They were speculating on price movements, planning to sell the contract before expiration. The system was designed for this, encouraged it, thrived on it. When a trader bought silver on the Shanghai Gold Exchange, they received claim to metal already sitting in certified vaults, physical bars, specific weights, verified purity. The transaction wasn't theoretical, it was real. And increasingly, buyers weren't reselling. They were taking delivery and moving metal into private storage. This single structural difference rewrote the mathematics of global supply. For decades, Western markets had operated on the assumption that Asian buyers were price takers. They would accept whatever price London and New York established, then pay a small premium for shipping and logistics. The system was comfortable, predictable, Western-centered. But assumption isn't strategy, and underestimation isn't analysis. By 2024, China had become the world's largest consumer of physical silver, not for investment, but for production. Solar panel manufacturing alone consumed over 200 million ounces annually. Every wind turbine, every electric vehicle, every 5G base station, all required silver. Not someday, now, not in contract form, in physical form. And China wasn't alone. India's industrial silver demand had tripled since 2020. Southeast Asian electronics manufacturers were competing for the same limited supply. Middle Eastern sovereign wealth funds, watching their oil-backed currencies face long-term uncertainty, were quietly accumulating precious metals as strategic reserves. The East wasn't just buying silver, It was draining physical inventory from Western vault systems at a pace that COMEX warehouse reports couldn't hide. Every week, eligible silver stocks, metal available for delivery, declined. Every month, the gap between registered and eligible grew wider. By January 2026, COMEX warehouses held barely 300 million ounces of silver, while open interest, outstanding contracts representing claims on metal, exceeded 3 billion ounces, a 10-to-1 ratio of paper claims to physical metal. In Shanghai, that ratio was less than 2-to-1 and falling. This created something financial textbooks say cannot exist in modern markets: sustained, systematic price divergence between integrated global exchanges. The same commodity, trading at persistently different prices in different locations. On January 24th, that divergence reached $12.66 per ounce. Shanghai's closing price of $111.66 towered over New York as $99.16, a premium of 11.3%. Textbook economics said this gap should close immediately through arbitrage. Buy cheap in New York, sell expensive in Shanghai, repeat until prices equalize. Algorithms should execute this trade thousands of times per second. But the textbooks were written in an era when physical delivery was assumed, when vault systems connected seamlessly, when metal flowed freely across borders. Those assumptions no longer held. Chinese buyers weren't just willing to pay premiums, they were insisting on them. Because the premium wasn't a fee, it was insurance. Insurance that the silver they bought actually existed, that it would actually be delivered, that the contract wouldn't be cash settled at some artificially suppressed price. Western institutions were slowly realizing they faced an opponent they couldn't outmaneuver with traditional tactics. You cannot intimidate a buyer who doesn't need leverage. You cannot trigger margin calls on entities buying with cash reserves. You cannot shake out weak hands when the hands belong to state-backed enterprises with multi-decade planning horizons. Every paper contract sold to suppress the New York price simply created another arbitrage opportunity for Eastern buyers. Every ounce sold in London was immediately bid for in Shanghai. The harder Western banks pushed prices down, the faster physical metal flowed east. It was monetary judo, using the opponent's force against them, and the flow wasn't reversing. Western vault operators reported the same pattern week after week. Metal arriving for storage, then immediately claimed for withdrawal and export. Silver Eagles minted in the United States were showing up in Asian dealer inventories within weeks. Swiss refineries were running at capacity, melting 1,000-ounce commercial bars and recasting them into kilo bars preferred by Asian buyers. The supply chain had reversed direction. For 50 years, the West had set prices and the East had accepted them. Now the East was setting prices through physical demand, and the West was discovering it had no response, because the response would require something Western financial institutions no longer possessed in sufficient quantity: physical silver, not contracts, not derivatives, not promises. Metal. The kind you can hold, the kind you can verify, the kind you cannot print. Shanghai's premium wasn't a market anomaly, it was a message. The message was simple. Paper claims no longer trade at par with physical metal. The 50-year experiment in separating price discovery from physical settlement had reached its mathematical conclusion. And that conclusion was now trading at a $12 spread for the entire world to see. The Western financial system could choose to acknowledge this reality, or it could continue defending the indefensible until the last ounce of deliverable silver left the vault system. January 24th suggested they had chosen the latter. The Shanghai premium kept rising, the arbitrage gap kept widening. And in New York, someone holding an enormous short position was beginning to understand what happens when the East stops accepting Western prices. They either deliver the metal or admit they never had it. There's a specific moment in every financial collapse when mathematics stops being theoretical, when the spreadsheet projections, the risk models, the carefully hedged positions all collide with a single undeniable fact. The numbers don't work anymore. January 24th, 2026 delivered that moment to every major institution holding short positions in silver. And the realization spreading through trading desks wasn't panic, not yet. It was something colder, more calculating. The recognition that their position had crossed from manageable loss into existential threat. The mathematics were brutally simple. A short position in silver means a trader has sold metal they don't own, promising to deliver it later at the agreed price. If prices fall, they buy the metal cheaper and pocket the difference. If prices rise, they lose money on every dollar of increase. At modest price levels, these losses are containable. Firms have capital reserves. Risk management departments set limits. Positions can be closed gradually. But silver hadn't moved modestly. It had moved violently. And the institutions caught on the wrong side weren't holding small positions. They were holding positions measured in hundreds of millions of ounces. Positions built over decades. Positions that assumed one fundamental premise: that paper markets would always dominate price discovery and physical delivery would remain the rare exception. That premise had just failed, At $50 per ounce, a bank short 100 million ounces faced theoretical exposure. At $70, that exposure became uncomfortable. At $90, it triggered internal risk reviews. At $111, the Shanghai closing price, the exposure became catastrophic. The calculation was simple. For every dollar, silver rose above the price where the short position was established, the loss multiplied by the total ounces sold short. A bank that had shorted 100 million ounces at an average price of $60 was now facing a $51 per ounce loss. That's $5.1 billion in the red, on a single position, before accounting for margin calls, before accounting for interest on borrowed positions, before accounting for the cascading losses in related derivatives. But the real crisis wasn't the loss itself. Banks lose money. It happens. Shareholders complain. Executives lose bonuses. The institution survives. The crisis was the delivery obligation. Because, unlike stocks or bonds, commodity futures contracts carry a final settlement mechanism that cannot be negotiated away. At contract expiration, the short seller must either deliver the physical metal or buy back the contract at current market price. For decades, this wasn't a problem. Most contracts were rolled forward or cash settled by mutual agreement. The actual metal rarely moved. But on January 24th, the trading data showed something that risk managers had nightmared about but never actually witnessed. Delivery demands were spiking. Contract holders who normally rolled their positions forward were standing for delivery. They wanted the metal, not cash compensation at current prices, not promises of future delivery. The metal, now. And the institutions that had sold those contracts were facing an inventory problem that couldn't be solved with capital injections or accounting adjustments. COMEX warehouse stocks, the actual silver available for delivery against contracts, had dropped to just under 300 million ounces. Total open interest, the number of outstanding contracts, represented claims on over 3 billion ounces. Under normal circumstances, with only 1 or 2% of contracts demanding delivery, the system functioned. 300 million ounces could satisfy 30 million ounces of delivery requests, with room to spare. But if 5% demanded delivery, that's 150 million ounces, half the available inventory. If 10% demanded delivery, the warehouses would be emptied completely, and the remaining 90% of contract holders would be left with paper claims on metal that didn't exist. The institutions with large short positions understood this mathematics perfectly. They had always understood it. The entire strategy depended on delivery requests remaining minimal, depended on traders treating silver contracts like financial instruments, rather than claims on physical property. Shanghai had broken that assumption. When Eastern buyers saw a $12 premium for physical metal, they stopped treating Western contracts as equivalent to metal. They started demanding delivery, taking possession, and either storing the silver or immediately reselling it in Shanghai at the higher price. Risk-free profit, guaranteed arbitrage. Every contract that went to delivery tightened the physical supply. Every ounce that left COMEX warehouses reduced the inventory available for the next delivery demand. And every reduction in inventory increased the probability that the next wave of delivery requests couldn't be fulfilled. This was the insolvency equation, not insolvency measured in capital ratios or balance sheet assets. Insolvency measured in physical reality. The institution had sold more metal than existed, had promised delivery on metal they couldn't deliver, had built a business model on the assumption that promises would never be tested, and now they were being tested. The banks had 3 options, none of them good. Option 1, buy physical silver on the open market to cover delivery obligations. But buying hundreds of millions of ounces in a rising market would drive prices even higher, creating a feedback loop. The more they bought to cover shorts, the higher prices rose, the more their remaining short positions lost value. This was the classic short squeeze. And in a commodity market with limited physical supply, it could send prices to levels that erased decades of bank profits. Option 2, appeal to regulators and exchange operators to change the rules. Suspend delivery, force cash settlement, impose position limits retroactively. This had happened before, most famously when the Hunt brothers tried to corner the silver market in 1980. But that intervention came in a different era. Before social media, before alternative exchanges in Shanghai, before millions of retail investors watched every regulatory decision in real time. Changing the rules now would destroy whatever remaining credibility Western commodity markets possessed. It would confirm every conspiracy theory, validate every claim that markets were rigged, and it would accelerate the flow of capital and metal to Eastern exchanges. Option 3, default, admit the position cannot be covered, declare insolvency, trigger the clearinghouse guarantee mechanisms. Let the systemic risk protocols take over. This option was unthinkable until it wasn't, because several institutions were simultaneously running the same calculation, and they were reaching the same conclusion. At $111 per ounce, their short positions had crossed into territory where covering was impossible and waiting was suicide. The margin calls were already arriving. Clearinghouses demanding additional collateral to maintain positions. Every dollar silver rose required millions more in posted margin, and the collateral couldn't be other paper assets anymore. Clearinghouses were demanding cash, liquid reserves, the kind of capital that couldn't be conjured with accounting creativity. For the first time in decades, the institutions that had controlled silver pricing through paper market dominance were losing control, not to regulators, not to competing banks, but to the physics of commodity markets. You cannot deliver metal you don't have, you cannot print silver, and you cannot negotiate with mathematics. The insolvency equation had one solution. Someone had to lose. Either the short sellers would be forced to cover at catastrophic losses, potentially bankrupting major financial institutions, or the contract holders would be denied delivery, destroying trust in Western commodity markets permanently. Both outcomes led to the same conclusion. The architecture of suppression had failed, and what came next wouldn't be determined in New York trading rooms or central bank policy meetings. It would be determined by a simple question that now had an urgent, unavoidable answer. Where is the silver?